Hey, it's the dot of 12 and we'll start on time because we have a lot to cover. Good afternoon, everyone. Welcome to the first presentation in a series of 4 of webinars on career transition and financial planning. And here's a special welcome for our civil service colleagues, and this series is open to everyone who could benefit from it. My name is Dolores Brown. I'm the counselor for retirees at AFSA, and I'm a Foreign Service Officer retiree myself. This series on career transition and financial planning was really the brainchild of a group of subject matter experts and individuals associated with the Foreign Service Institute who wanted to help. They recognize that many of you haven't had the opportunity to take courses on retirement or career transition or financial planning, and they in turn wanted to be able to present some information to you, some not courses, we can't do courses, but webinars to assist you in all of this. So they in turn recommended some very accomplished speakers to come to talk to us. So I owe them a debt of thanks. Thank you very much. This series will be presented over the next month and was advertised in a recent AFSA. You probably know that because you're here. The Zooms will be posted on AFSA's website after the fact. So if you can't join live in the future, you can always benefit from them by accessing them later. So a few quick words on the modalities of this Zoom. The presentation will be about an hour long with 15 minutes of questions and answers. Please post your questions in the Q&A function, and we'll get to as many as practicable. You're muted and off screen as we're recording this presentation, and so we need to make sure there's no sort of interference in it. And at the end of the session, if you wouldn't mind, it would be very helpful to us if you would complete a survey. It's very short, I promise you. And I'm especially interested in any suggestions you might have for programs that we could do to further aid you. So please take a moment to do that. So now I'm very pleased to introduce Dr. Catherine McCormick, who is one of the individuals who is the brains behind all of this and approached AFSA to do these programs. Dr. McCormick has worked with adults in career and life transition as a career counselor for more than 40 years. And most recently, many of you might know her as the director of the Career Transition Center at FSI. So over to Dr. McCormick.
Okay, well, thank you so much and welcome everyone. These are hard times for you, and we hope that the information that you gain in these sessions is helpful. I would like to just briefly make sure you know a little bit about our presenter. Her name is Karen Schaeffer. She's a certified financial planner, and she's instrumental domestically and internationally in training other people who become and are certified financial planners. She's an amazing speaker. I've seen her talk for 3 hours without any notes many times and was just in awe. So you've got the best here, and she co-founded an organization called Schaeffer Financial. Some of you are familiar in Montgomery County, Maryland, and we are very pleased to have her helping us by advising you during these uncertain times on financial issues. Thank you, Karen. Go ahead.
Okay, thank you, Kathy. And I'm really pleased to be here. This has been my career, helping federal government employees make smart money decisions. But I learned real early on that I'm not the planner in your family, you're the planner. And this is probably just driving everybody crazy when the future is so gray and so uncertain and every day is different. But what I can share with you is that sound financial planning helps. And I'm going to lay out just some logical steps that you can, in fact, be thinking about and taking. I'm not going to spend a lot of time on your federal retirement options since those seem to be changing, and AFSA will have specific retirement benefit resources available to you. But you do need to hear about what a financial planner thinks about when to take that Social Security check, the pros and cons of taking it at different times. And then I'll get through the bulk of my time will be where financial planners really stay in their lane. Thrift Savings Plan, it does change your allocation decisions and how much attention you're spending with your thrift savings plan changes when you're no longer adding to it, as opposed to when you're buying and the market's up and down, doesn't matter. You're buying. We'll talk about whether or not you should be considering moving your thrift savings plan to an individual retirement account. There are always advantages to individual, all about me accounts versus any kind of group employer-sponsored plans, but the advantages aren't for everybody. So I've got to slow you down a little bit and make sure we're thinking about personal financial planning. And then a couple appropriate use of debt. Let's, really the last couple of slides are, don't make this worse, right? It's so easy to be mentally exhausted, emotionally frightened, angry, we can keep piling on, right? All of that very justified and understandable. But the fact of the matter is, it can get worse if we don't just clear our heads a little bit and make some good decisions. I also want to introduce Caitlin Yardley is behind the scenes. She's a certified financial planner with lots of experience, again, with federal government employees. Since we're kind of a big group, she's going to try to answer some of the questions that are either repetitive or pretty straightforward. And then I'm saving time at the end to get the questions that the whole group can benefit from. And Kathy will be back to help me with that. So with that, let's start getting through some of these. I mentioned that AFSA has some other resources for you. These slides will be available to you as well. So make sure that when you really need to drill down and make sure what you're eligible for or what the difference is going to be if I go with this direction or that you've either talked to your human resources people, looked it up at OPM, or worked with AFSA as well. Because we don't know yet, but we think maybe there will be VERA for some of you folks. It's I've been through VERAs before. I've been around for a long time, where there's a little downsizing, maybe make some room for somebody else to come in, or just a discontinued service requirement. You're familiar with these terms, or actually a VSIP where there's some money. And just from a high level, when you're looking at these options, if they become available to you, please know from a financial planner's point of view, the only people who really should be considering these are people who really are financially secure. We're kind of ready for retirement anyway, right? And it's like, if they're going to put some money in your hand, put your hand out for it, right? And or people who are very confident that if they're more of a mid-career stage of life, that you're reemployable at the income level that you need to be at. None of these downsizing opportunities have ever been generous enough for me to say, oh my gosh, I got to get out there and have everybody signing up. And it's hard to hear because you're frustrated and you don't know what staying in really means. But if I think back on the people that we've actually counseled individually, there's a bit of a pattern here. If you're going to give up your job, you have to be financially ready to give up your job or have skill sets that are highly sought after in the private sector. So deep breath. Don't be racing out the door if you don't need to, and we'll see. We'll get through this together. If you are, though, separating from service with a retirement, and not only would your retirement be based roughly on your highest 3-year average and your creditable service, we also have to think about this whole supplement that you get if you're under the age for Social Security. Now, that'll just come to you automatically, but some of you are going to be at an age where you now have to decide, once it ends at age 62, when do you take Social Security? So keep in mind just a couple of things about Social Security. You're really discouraged from working if you take your Social Security at age 62. So if your supplemental benefit comes to you automatically and then OPM stops when you're 62, you could, the very same month, have that Social Security check start. But there's a give back. For every dollar I earn, over a fairly modest amount. Every $2 I earn over $20,000-ish, I start giving back my Social Security check. So earning in the low 40,000s means I really shouldn't have taken my Social Security check because it would zero it right out. So the first big consideration is, do you need to work, right? Or just want to work? You know, the brain is kind of a use it or lose it body part. You might want to, if you're in your early 60s, to stay engaged, especially those of you who might really be on the path of living into your 90s. So make sure we understand whether or not you need or want to work before you apply for your own Social Security check. And then let's think about how it really works. Whenever you apply from 62 to full retirement age under Social Security, that's when they're going to discourage you from working, where you're going to be given back some of your Social Security check. But from 62 to full retirement age, what year were you born? For most of you, it's going to be 67. But every month counts. So maybe it's 66 and 10 months for some of you, right? Every month, all the way up to age 70, your Social Security check gets bigger. So you've probably read lots of articles now that baby boomers are taking Social Security checks. It kind of got to be a hot topic there. You probably have read that, well, I should just wait to take my Social Security check because it's growing by 8% a year until everybody should wait till 70 if you've got kind of long life expectancy because you get that big check. And the problem with thinking it through that way is that we're not comparing really apples and apples. If you really think about your Social Security check, depending on when you sign up, you're either going to get a smaller check for a longer period of time, or you're going to get a bigger check from Social Security for a shorter period of time, because we pop off when we pop off, just the way that is, right? So if I waited until I was 70 to take my Social Security check and then died at 71, I missed out on 3.5, 4 years of Social Security checks that nobody's going to get. If I waited to age 70 and to take my Social Security check, but was taking money out of my Thrift Savings Plan to maintain my standard of living from the time my supplements started all the way up to age 70, somebody does get any leftover money in from my Thrift Savings Plan, but it'll be a smaller amount. So another way to think about this, it doesn't make a lot of sense to me to be pushing off a Social Security check that I'm eligible for as long as I'm out of the workforce and want to be out of the workforce and I'm past the age where I get that little give it back to Social Security penalty. If you need or want the money, you take the money, provided we're out of that window where we have to give something back. So I've had clients wait to age 70, without a doubt. I've had couples where one waits to age 70 and the other claims a little earlier. I've had people really need the money. Who are we kidding, right? That's an easy decision. There's only so much money and there are so many obligations. We're going to take that check. I've also had people take it before age 70, certainly, because they had a very specific personal goal. They were helping with grandkids' education. They were giving back to a particular charity for which they had a great passion for. And so this is not going to be one size fits all, right? But you do have a big decision to make here, and it's a personal one. You'll automatically get your supplement when you retire, and then when it drops off at 62, then you have to be thoughtful. Are you completely out of the workforce? Maybe we're going to take that smaller Social Security check. Or are we working a little bit part-time to take the edge off? Or are we in a full-blown second or third career? We're definitely waiting till full retirement age. That's the next data point, decision point here. At full retirement age, now think, what would I do with this check? Right? Would it really be meaningful to me? Or I wouldn't even notice it. Might wait a little bit longer. At age 70, we all take it. There's lots of other things that are going to happen with your decision to retire. Some of you have to go document your creditable service. Some of you have deposits or redeposits to make, or some military time. If anybody's in the old civil service retirement system, you had a voluntary contribution opportunity. And I just put this slide up just to remind people, just take the deep cleansing breath and be thoughtful. The resources are out there, but we're all working around the clock. So the more focused you can get your questions, the more likely you're going to be able to get somebody to help you think it through and make the right decision for you. All right. So you will also have to make a decision about your health insurance based on which of the different opportunities for separation that come your way, whether or not you're going to have health insurance. Most of you do, but there's this 5-year requirement that you have to have participated in the federal group health for the 5 years to be eligible to take that into retirement. So be a little careful about that if you've been on a spouse's plan, and also be really on top of it. If you're not going to be able to continue your health insurance, there is a COBRA-like opportunity for most of you. It gets very expensive, and most of us end up looking for health insurance either through professional associations, the foundation, the Financial Planning Association has actually great health insurance and disability insurance for financial planners. And then there's the National Association of something similar to what you are, where we look for benefits, or we go to the state exchanges on that. Those of you who have to make the decision to whether you're closer to the end of your career anyway, you've got a decision to make on whether or not you're going to get Medicare Part B. And again, there's benefits people who could speak hours on this particular topic. But because the federal health plan is so nuanced, you've had choices on which health plan to take. Please know that sometimes if you don't take Medicare Part B, your coverage is going to be limited to what Medicare would have paid for. And if there's somebody on your plan, you've got a family plan going on, and they're not eligible for Medicare, they're still getting the reduced benefit. The advice from us is we're going to assume you need Medicare Part B until you come up with a compelling reason not to have it. Literally going to your plan, going to a benefits expert who can explain to you how that really works. And I know you don't want to pay for it. And I know that it's now means tested, and people are kind of shocked at how I thought once I got to Medicare, I could relax here a little bit, but it's your health insurance. And we do a lot of talking people into this because they haven't been sick. Why would you need it? Well, wait a minute. Go out into the future and we start having things happen. 20% of a big number is still a big number. And you don't want to have that 20% copay that could have been picked up from Medicare Part B. And of course, the penalty for enrolling late. So just write this one down. Those of you who are at that stage of life, the financial planner says we almost always recommend Medicare Part B. It does depend on which plan you're in, which federal health plan you're in, but if you're just, don't be casual about it, about that decision. And this is, you'll get these slides. The disadvantages really are the cost for most people. You also have to know that some of you are going to lose your life insurance depending on how you separate from service. And it's been a best practice in financial planning that we generally would have been coaching you along and along to have your life insurance separate from your employer anyway. So if you've always had all your life insurance through Federal Group Life and you know you're going to need life insurance even if you're separating from service, let's do that today. Maybe, later the same day. Let's look at what our options are for getting life insurance outside of federal group life. It's not because your federal group life plan is really a bad plan. It's just that in any group plan, the healthiest among us are subsidizing the not quite so healthy. Somebody who's a healthy non-smoker can always beat the cost of federal group life pretty much at any age, right? Simply because you're being underwritten just on your perfectly good health and not on the group's sort of on average good health. Makes sense, right? And the other thing about your federal group life, it does go up every 5 years. So if you're in your 40s, you might be paying for all the supplements and thinking, oh, it's not that expensive, but it does kind of take your breath away as you continue employment and goes up every 5 years, or if you're separated from service and now you're scrambling. So I would prefer that if you are pretty certain you're going to lose your job, that we just go out and look for what kind of life insurance is out there. We don't want whole life, universal life, variable life. Don't get talked into any of these plans that have savings and cash value. It's the most expensive way anybody can try to accumulate some wealth through a life insurance, a complicated life insurance product. But we're just talking about basic death benefit. If I died today and took my paycheck with me, but left my assets behind, is there somebody who's going to suffer financially? As a young 21-year-old college grad, barely supporting myself, the answer was no. As newly married, just bought our first tiny little house, the answer was maybe a little bit of life insurance. As a 30-something-year-old starting a business, starting a family, bought in the real house with the real mortgage, I needed more life insurance than I wanted to admit to. And then at some point, the life insurance need falls off again. I'd like to think somebody would miss me, but if I died today, they get all the stuff, right? When you're getting started in life, you haven't accumulated much stuff, but a lot of people, or certainly more than you, depending on your paycheck, that's when we really need the life insurance. So term life insurance is perfect for that. You go out into the marketplace, look for a term life insurance policy that would replace what you're taking with you. Maybe the ability to make the full mortgage payment relies on your paycheck. Educating kids, it's a pretty classic one reason why we have life insurance. Get that policy in place and then reduce your options down to basic. I almost always have everybody keep the basic life insurance because it's subsidized, right? You're not paying full dollar for that. And when you separate from service, you can take the option to have the death benefit reduce by 75% and never pay a premium after age 65. So it's kind of like a little, you've kind of been working on this little freebie thing, and you might want to just keep that. And again, depends on your age. The basic amount is subsidized. Those options are not, and they're more expensive at any age than buying the same amount of life insurance in an individual policy, provided what? You're the healthy non-smoker. I think most of you can look this up to see what your real cost is, but it's those optional coverages that I find are more expensive. The 75% reduction, I'll just give you an example of what that would be. So let's say I'm separating from service and I'm 57 or early 60s, and I just keep the basic life insurance. And let's say my salary is $100,000, so we can do the math in our head. All right. So I separate from service and I pay my premium just on that $100,000. The federal government's paying 1/3 of that until I'm 65. And then at 65, because I've opted for this 75% reduction, my life insurance every month is going to go from 100,000 down to 98,000, all the way down pretty quickly till it's $25,000. And then I never pay a premium again. Now, $25,000 death benefit isn't, in today's dollars, going to be putting anybody on easy street, but it's $25,000. And at some point, I almost always recommend, why don't you name your favorite charity for that $25,000? Once you see that the $25,000 is insignificant to whoever was your beneficiary, I recommend you change that up. Got a little problem with long-term care insurance these days, just because underwriters are seeing what some of you have seen in your own families. Wow, it can take a lot of money to give somebody the kind of care they need as they go through their frail last years of life. So your own government plan has stopped taking applications. First, they dealt with the people who already had policies in place and offered them a slightly reduced benefit at the same cost or a lower cost and lower benefit. So it doesn't mean that the problem went away, right? It still costs a lot of money to get old and frail, but it does mean, because the underwriting has become more realistic, that many of us are going to have to understand that we're either going to work a little bit longer, or we're going to consider an asset that previously was just going to be, I'm going to leave this to the next generation, or this is going to be, I'm going to do a downsize and have more fun. The equity that a lot of people have in their homes is going to have to be tapped for their care. And how we do that, well, that's a subject for a whole other webinar. It's not a reverse mortgage, but it is when you're thinking, can I really just afford to take this VERA or VSIP and not work again because I have had it? Well, you're healthy now. What if you became frail? And who would pay those costs? How long would your money last, right? With now that you'd be looking at a pension and maybe a Social Security check or supplement and thrift. How long will all of that money last for you? Do we need to maybe get another little part-time just to take the edge off? All right, so transitioning now into your thrift savings plan, the maximum amount that you can put in is different based on how old you are and the year you were born. It got more complicated just this year, where now the 60 to 63-year-olds can put in even more than these extra 7,500 that the certain people of a certain middle age, at the 50 and older crowd, had been doing. But everybody is allowed to put in 23,500. I've been getting a lot of questions on, okay, Karen, what do I do with my contribution this year? And some people are assuming I got to stop putting money in thrift because I'm this close to losing a paycheck and I'm going to need all my money. But I got to remind you, this is personal. And I've also talked to a number of people who were increasing contributions into thrift because they did have a good financial plan going on. And this chaos on career path is coming at a time where they were probably going to retire anyway. So the answer for some people is, yeah, let's get a bunch of money in your thrift savings plan because it's calendar year, right? And if you think you're out of here in a couple of months, then we could put the full amount in. It just has to be payroll deducted. But if you really think you might be losing your job and you're not prepared for handling day-to-day expenses that without going into debt or having credit card bills piling up, then we are advising some people to reduce their contribution down to the 5%. You don't want to lose the match. The other caution flag for those of you who might be accelerating payments because you're pretty sure you're out of here, that 5% match is on a paycheck by paycheck basis. So if I got my 23,500 in by June 1st, because I think I can afford to retire and I'm planning on being out of here June 1st, I'm just hanging around to see if they give me a little more incentive, right? But then something happens and I'm still employed, I won't be getting any matching for the rest of my checks for the rest of the year. So, yeah, I know we're being asked to have crystal balls and nobody has one, but what are the odds? Right? Let's at least go with most likely scenario for you. Now, when you're thinking about your thrift while you're working, I don't know how many of you have come to classes where I've been teaching this forever, but a lot of you have, because I've had a lot of people saying, if it wasn't for me meeting you, I wouldn't have that $1 million plus thrift savings plan, because I've taught a lot of classes for people just getting started. While you're working, you really can kind of set it and forget it, because whether the market's going up or the market's going down, you're buying every single paycheck. So, the five core choices. You've got the G fund, which is kind of like buying a treasury bill. It doesn't keep pace with inflation. You've got a bond fund, the F fund, that is just kind of an odd bond fund. You know how bonds work. You lend your money to a company or the government, they give you money back on a guaranteed, predictable basis. But this particular bond fund, because it has short-term bonds, intermediate bonds, and long-term bonds, we don't expect defaults. These are high-grade bonds, but it really fluctuates with interest rates moving. So it's just not really the kind of bond fund that I reach for. And that's not some big, bold, crazy lady statement. When you look at the L funds, the professionally designed portfolios that use all five of these funds, they're not using it either. All right. So while you're working, it's been pretty easy to just focus on the stock funds, large US company stocks, the C fund, smaller, everything else, intermediate and smaller companies in the S fund, or the internationals. And whether the market was up or down, you've been making some really good money, because markets go up more than they go down. And for the most part, right, when the market's down, you just buy more shares. So when you're no longer adding, the volatility of not adding when a market is down is going to start to show you, for many of you, for the first time ever, that, wow, that thrift savings plan, look, the last time I looked at it, it was this balance, and now it's what? How did that happen? And it's because you're not adding. So when the market goes down, your account goes down. When the market goes up, it'll come back up, but it comes back so much faster when you've bought in the interim shares on sale. I'll give you an example. In 2008, some of you remember the Great Recession of 2008, the US stock market dropped so much in the whole year 2008 that even if you had put the full amount you were allowed to contribute into your thrift savings plan that year, your balance was less than in December than it was in January. And then it got even worse early in 2009. But if you kept it up in 2009, we made 60% in 3 months, the second quarter in 2009. So in 2009, you were back to seeing, oh yeah, I love my thrift plan. It's bigger than it ever was. It was 15 months of really stress and struggle for people who just kept buying into the CS&I funds. If you were retired, separated from service, willingly or unwillingly, in 2008, and you had $1 million in your thrift savings plan, that balance probably dropped. And it was the only way you had $1 million was you were all in stock. So that balance dropped to $600,000, maybe even $500,000, and didn't get back to $1 million in 2009, 10, 11, 12, or 13. Maybe in 14 if you were only in the C fund, but some people saw their thrift accounts be worth less for 10 full years. I'm just saying that if these stock funds have been your besties, right, and you're now never going to add to them again, we either need to manage that risk by moving to an IRA where we can have more moderate accounts, or you got to get more money into that G fund, which means no more growth on it. It just means no more loss either. These L funds all use, as you know, G, F, CS, and I. and are a pretty good choice for a lot of you while you're working, and or use it for the first time when you separate from service. If you think you've got enough money for the rest of your life, you don't want the volatility, you don't want the chore of going to figure out how do I move money to an IRA. That's what your L income fund was designed for. It is not designed for growth, but it's definitely designed for somebody who thinks they have enough money to now get through the rest of their life and doesn't want that volatility. Because when you look at that L income fund, it is 69% G, never to grow fast enough to keep pace with inflation. But if you're kind of toward the end of your career anyway, that might be what you need to do for peace of mind. Look at the 2070 fund. That's 99% stock and 1% split between G and F. So if that's where you are and that was where you were supposed to be, right, then you got to just know when the market drops, you're going to see that drop. Ignore it, right? Because when the market recovers, it still is long-term a better place to be. But what I find is that because so many of you get into retirement having never really felt market drops, because people who are buying don't feel it, don't see it for as long, they forget. They might need to rethink their allocations and just get more moderate, right? So the worst thing anybody does with a portfolio when the markets are down is a market drop, is a panic sell. When the market drops, the panic sell. So they know thyself, right? What's your temperament? Are you pretty good about looking at market history? The data's available since 1871. Stocks have outperformed bonds, bonds have outperformed government bonds by a huge amount. And knowing that, can you just watch your accounts drop? Because this is long-term money. I might be in my 40s, but I'm going to get reemployed someplace else. I'm not reaching for this money no matter what until I'm in my 60s or 70s. Do you know you can avoid the panic sell? And if so, just stay in stocks, or do you need something a little bit more moderate? Or are you in your 40s thinking, yikes, what if I really did have to tap this? Because I really do think I'm losing my job and I might not be reemployable where I happen to live or with my skill set. You do a choice when you're making these contributions to do Roth versus traditional. And I just have to remind people, just because you can do something doesn't mean you should. This is where we're all being forced to make a deal with the devil of tax law future, right? If I put money into traditional, I'm not paying any tax on the contribution. When I'm putting money into the Roth, I am paying tax on the contribution. While the money's in there, they're exactly the same. But when you take the money out, that's when we get the difference again. Now, up until now, you haven't been able to change any of your contribution money from traditional to Roth. If it was in traditional because it was your agency match, or you put it in traditional, it was going to stay in traditional. But starting next year, if you're looking at your thrift plan, you could move some money into from traditional into Roth. And maybe I'm going to find a person that I recommend that to if they've decided I've separated from service and I can afford to go to grad school and I'm going to be in a zero bracket for the next 2 years. That's when I would think, hey, see that money in your thrift savings plan? It's a really good year for you to convert it, pay the tax on it, and then get tax-free going forward. But people who are mid-career or later, I don't know that it's going to make any sense to take traditional money and pay tax on it now when tax laws change, right? When, I don't have another slide on that. Well, the tax laws could change. You might not live long enough to make this worthwhile. I'm 70 and a half years old. If I converted my traditional IRA to a Roth IRA today, I can do that. It doesn't matter how much money you make. Anybody can do it, right? You're going to be able to do it with your thrift plan. I may not live long enough to have that make any sense, because not only am I giving up the tax, I'm giving up what that would have grown to over time. So there's a lot of tweaking always with retirement accounts and IRA rules. And you've got to remember, some of these rules are not designed to make you more financially secure. They're designed to raise revenue. Because when we do these conversions, when we do these changes, guess what happens? We end up paying more tax. So be a little careful about your decision on whether you want to change any of your Roth contributions right now, your thrift contributions right now to Roth, or next year when we have more of a choice. Be a little careful about that, which is very different than an IRA. IRAs, you don't ever get a chance anymore to make a contribution that's a pre-tax dollar. So we love Roth IRA contributions. It's Roth thrift contributions or conversions that you got to just be a little careful about. Now, you could take a loan against your thrift savings plan, but let's be careful about those right now. I've always been very cautious about loans against the thrift savings plan, not because they're expensive. A $50 loan origination fee, that's not a big deal, right? And it charges you interest, but the interest is relatively low. And guess where the interest goes? Right back to your own account. So I've had lots of questions. So shouldn't I be taking a loan against my thrift savings plan? What if I lose my job? Wait a minute. You lose your job, you separate from service, however, in whatever form, right? That loan needs to get repaid ASAP, because when you sign up for a thrift savings plan loan, they automatically take a payment out of your paycheck. When you separate from service, what happens? No more paycheck, right? So it used to be immediately it was in default. Now, as of, I think, 2024 or 2022, when they did the big upgrade to the website, you can make arrangements to get that repaid. It set up some scheduled payments or just refinance it and pay the whole thing off. And why am I harping on this? Because if you fail to repay a thrift savings plan loan, you will have to report the outstanding balance as taxable income, even though you don't get another loan, right? So I borrowed out $25,000 and bought a car, and I've only paid $5,000 back. And I got a lot going on, right? I kind of forget about this loan because it's not top of mind. It's just a payroll deducted thing. Next April, I'm going to get a 1099 that says I have to report $20,000 as taxable income that, hello, I don't have. I got a car, right? And if, depending on my age, maybe a 10% penalty on top of that. So there's a huge caution flag waving for anybody who currently has a loan against their thrift savings plan. There are more loans outstanding against the thrift savings plan than ever, which is not good, because even without this little, hey, caution flag about the separating from service, they were always a bad idea. In my example, I'm only borrowing $5,000. I'm paying it back in 5 years, and the G fund was only charging 2%, right? So what's the big deal? Well, if I hadn't taken that loan, I would have had an average rate of return much closer to 8% because I would have been in the stocks. So how could that be such a big deal? It's arithmetic. Play it out. 30 years into the future, this little loan at a low interest rate cost me $16,000. My thrift savings plan is $16,000 less 30 years out in the future than if I had never taken this loan, or if I had taken a loan from the credit union and just paid them a couple $100 worth of interest over, $5,000 over 5 years. It's not that much out of pocket. So loans against thrift savings plan, we call them lost opportunity costs, and those lost opportunity costs keep getting bigger and bigger and bigger for the rest of your life. Now, this is a slide I've had for a while, and I was usually just using it to show people, leave the money alone, right? Because the example, twin number one, I like to be the smart twin. I invest $2,000 a year, earning 8% a year, little stock mutual fund, and then I stop investing at my age 40. My twin brother, Kevin, I don't know what happened to him. He doesn't even start investing till he's 41, right? But he puts in more than I did, and he invests over a longer period of time than I did. But look at our account balances. On our 65th birthday, I've left him in the dust. The reason I wanted you to look at this slide, depending on where you are in your career, you're going to be really tempted to grab your thrift savings plan money to get you through and look at what it costs. You don't make that money back. So in my example, right, I'm the one who separated from service and somehow begged, borrowed, worked a job I hated, definitely I'm overqualified for, so that I didn't take money out of my thrift plan. My twin brother, Kevin, this is an example of somebody says, well, it's not so much money and I'm still young and I've got the rest of my life ahead of me. I'm going to grab that money. That's what happens. All right. So I did talk to a young USAID person right out of college, got his job, thought it was his dream job. And he lost his job. He got it back. He lost it. I think he got fired twice in 1 week. But we looked at his expenses and I said, you only have to make this much money. He has a condo in Arlington, and this is your fixed overhead. You got to make that payment, and a little bit. I guess you're gonna have to eat a little bit. So, what kind of job could you do just to earn this much money? Because this is all you have to earn. You don't have to get professional income yet. We just have to earn this much while we get more information about what your next step will be. And he really pushed back. He did not want to take any old job. He said, well, you're not taking any old job. You're covering enough of your expenses so that you don't hate yourself in 2 years, because you will have all kinds of credit card debt, or it gets ugly pretty quickly. So this is, even though there's money in your thrift savings plan that you could just pull, it's so expensive that we're coaching a lot of people to, hey, could you rent out your place and go bunk with a friend for a while, just to keep your thrift savings plan as sacred, important money. When you do get to a stage of life when it's time to take money out of your thrift savings plan, it's pretty easy to get it. We really wait until you absolutely need it, and then you just ask for a dollar amount. That's called a partial withdrawal, or you set up a scheduled payment, and you can mix and match those payments. The scheduled pay, I know I need $2,000 a month, but I need money, spring and fall for my travel expenses, or I need a lot of money, I'm buying a car, kind of thing. Because once you take the money out, if it comes out of traditional, it's taxed. If it comes out of Roth, it's tax-free, but no more tax advantage growth on it. So we kind of wait until you really need the money. Single payment is just what they call close the account. And I can honestly tell you, I've never had anybody do the annuity option. And the reason I wanted to bring that up is because annuities are kind of sold on fear, right? Annuity is a legitimate investment product, but it comes out of the life insurance world, which is very, it's just hundreds of years of selling on emotions. And human nature is you like the guarantee. So you'll get people explaining to you that, well, you should move this through savings plan and buy an annuity, and then you never have to worry about what the market's doing. But what did that cost? Like, for a lot of people, it's a huge unnecessary expense to get a guarantee that we don't need. We really need more flexibility to handle an uncertain future. When you do take money out of your thrift savings plan, it will come out prorated from all your positions. So if you've got your money in that L income fund, 69 cents of every dollar is going to come out of the G fund, and the other 31 cents gets split a few bucks out of F, CS, and I. Right? If you've got 50% of your money in G and 50% of your money in C, that means that 50 cents comes out of cash, 50 cents comes out of the stock market, the large, too big to fail C fund stocks, right? And the reason you can tell them, you can be strategic with when you're taking Roth money and when you're taking traditional money, but it comes prorated out of your investments, and that's kind of a big deal to understand. In the real world, when we're not limited to this prorated withdrawal, if the market's down, where do we take the money from? Cash, like the G fund. When the market's up, where do we take the money? Depends, right? I might want to take it all out of the market because, sort of the take the money and run, or I might want to take a little out of both because the market-based stuff is doing just great, or I'm taking it all out of the market because I don't want that position anymore, right? We have choices, and because we have choices, we can make the money last longer. I don't know why they didn't change this when they did the big upgrade in 2022, but it is a reason that some of you who need to do those targeted withdrawals will consider an IRA. The Thrift Board can do required minimum distributions, which is nice. They couldn't do them until recently when they did their big upgrade. But one of the things that I want you to pay attention to is it's on you to keep your information current with the Thrift Board once you separate from service. I do this training at the Thrift Board, and I always ask, I feel like I've come to the mothership. What do I need to be telling everybody? And it's consistent. Make sure they're keeping their information current with us when they retire. And I finally asked, why wouldn't you keep your bank routing information current and your snail mail address current with the Thrift Board? Well, it turns out while you're working, your agency does that for you. Once you retire, you don't have an agency. And this becomes a big deal, this keep current the information when you think about required minimum distributions. Hello, they're required, right? So you fail to make a required minimum distribution, that could result in a 25% penalty. The Thrift Board knows how old you are, knows if you're retired or separated from service. They know how to do the calculation, and they want to help you avoid that 25% penalty. They need to be able to find you, right? So what they don't know is, are you waiting until the end of December to take your required minimum distribution? So they wait and wait and wait and wait and wait. And then if you haven't taken enough, they'll send you the money. If your bank has been swallowed by Bank of the Universe, the routing information doesn't work, it'll bounce back. They'll literally cut you a check. And if it gets to a mailing address where the forwarding address is expired, you're going to face a 25% penalty. So just no penalties, but just remember that eventually we're going to have to start taking money out of these accounts. And once you start, you have to keep it up every year until the account's zero. Another thing just to know, only your spouse can continue to have an account with the Thrift Board. It doesn't mean only a spouse can be your beneficiary, but only a spouse can be what's called a thrift beneficiary participant, can continue to have the account there. So if I'm the federal government employee, I've got a thrift savings plan, I die, my husband Rick is my beneficiary, he can continue to get those partial withdrawals or scheduled payments. He can change the allocation. He can move it to an IRA. But Rick dies moments later, brokenhearted. Now the beneficiaries are the kids, and the kids cannot continue to have an account there. I've seen Thrift pay out to the non-spouse beneficiaries, in my example, the kids, in 30 days. That means no more tax advantage going forward, means maybe all the tax, if it's coming out of traditional, all in one year. If it comes out of Roth, there's no tax on that. So let's try it again. I'm the Fed. I have a thrift savings plan. I die, and Rick is my beneficiary. Somehow, in his grief, he manages to get that account to an IRA, individual retirement account, and then dies brokenhearted. The kids now, that one strategic step gave the kids 10 years to move the money out of the account. Sometimes we take it out early because the kids are in low tax brackets. Sometimes we wait until the 10th year and then couple that with a once in a lifetime charitable contribution in mom and dad's name, and all kinds of ways we can think this through over a 10-year period of time. And for some of you, that's worth considering. For some of you, it's like, that's the least of my concerns right now. Make sure you understand also that you have to double check and make sure you have a beneficiary designation in there, because when they did the big upgrade, Thrift Board estimated about 250 of those beneficiary forms kind of got lost in that cloud or cyberspace, with the database upgrade. And we've all seen that. We know that can happen, but it's the only form they use. So if you have got a copy of your form, that's not going to work. If it's very clear in all your estate planning documents, you've always named the same beneficiaries, that's not going to work either. So you've got to look at your thrift plan every once in a while anyway. How about just check in today to make sure there's a beneficiary form in there. The reason some of you are going to think about moving your IRA, your thrift money to an IRA, is because you want more investment choice. I can find a better bond fund. I can, again, invest in a couple. I usually just invest in mutual funds, but there's a couple of companies that I might want to invest in that I'm personally more aware of, and see if that's something I want to do. The fact of the matter is that's not for everybody. Some of you are having more than enough choice just with those 5 core funds or the 10 L funds, right? But that is an advantage of an individual retirement account. I can also use different strategies for my traditional and Roth investing because I'm going to spend them at different times. In the thrift plan, they get invested the same. I clearly can take money out of cash when the market's down, money out of the market when the market's up. I can, but is that something that you're going to do, or are you one of those lucky ones who are already at a point in your life where you've got more than enough money and you're done with market volatility? You're going to be in that L income fund anyway. I just explained the tax advantages for the non-spouse beneficiaries, and there's one other thing that IRAs can do that employer-sponsored plans, this is not thrift specific, can do, and that's send money directly to a charity and have it qualify for my required minimum distribution and me not pay tax on it. So those are the advantages of IRAs over the thrift savings plan. But the problem is, for some of you, the IRA could be too expensive. I can give you examples of IRAs being less expensive than thrift. Discount brokerage firms, Schwab, Fidelity, Vanguard, T. Rowe Price, you've heard of those places. Their fees keep coming down. Thrift, it's bouncing up a little bit. We're tenths of decimal points, but still, where the cost comes in is when we end up with advisors charging high fees or recommending expensive product. If you're pretty sure you want to move your money to an IRA, you're a do-it-yourselfer, you're very comfortable with discount brokerage firms, or you're working with an advisor who you really understand what their fees are and they're bringing value to the table, that you understand what the cost is, just leaving $200 in your thrift savings plan allows you to come back. Right? So I don't want anybody to make a hasty decision on this. This is not one of the decisions you have to make right now. You can leave it there, do your homework, let life settle down a little bit, but it is a best practice. You want as few retirement accounts as possible. So all your former employer stuff in an IRA or in thrift would be better than lots of little accounts. So something for you to think about. And then just be careful when you're moving money. We do transfers. You don't, getting money from one retirement account to another is not a taxable event done correctly, but we see people make mistakes with rollovers. A transfer just means it goes directly. You never got the money deposited in an account. You didn't get a check made payable to you that you then move on. So that's the caution flag. The financial institution that has your money, that's your custodian. I'm a pretty practical person. If you're already comfortable or familiar with Vanguard, you're going to go to Vanguard, right? But that will be make it or break it on whether you're happy with it. It is true that if you move money to an IRA, it will not be available to you without the potential for a penalty until you're 59 and a half. And employer-sponsored programs like your Thrift Savings Plan, you're eligible, if you've separated from service, to take without a penalty as young as 55. There's all kinds of exceptions to that penalty rule, but during this period of uncertainty, maybe not rush into that IRA if you can handle the volatility of your investment. And then finally, I just got to make sure that nobody's relying on debt to get through the crisis if you can afford it. If this is really coming at you as a surprise, you just bought the real house, it's got the real mortgage, call them, be proactive. Look for, there's lots of suggestions online about how to be thrifty, and just try not to take the slow down on the thrift if you don't have to. We've had people call creditors and get 20 some percent interest rates on credit cards down to 3% for a short period of time, right? If you're really, you're going to be late with your mortgage, or it's just a matter of time, contact this organization. We use them a lot during COVID. For people who lost their jobs. And there's something called a hardship letter, and it goes in your file. And each lender can be a little bit different, but make sure you can be proactive with any debts that you have. And then people are preying on your fears. So antenna up, guard up here. People are going to come in and tell you exactly what you want to hear. And then the next thing you know, you've been taken advantage of. So with that, I'll leave this resource slide up. Tammy Flanagan is a colleague and a friend of over 40 years, and her company does counseling on the benefit. Some of you have some big deal benefit decisions to make. And the CFP board, if you go to their website, they're offering a webinar this Thursday night. If you have colleagues who need to hear more about financial planning, it'll be a little bit longer. But the Foundation for Financial Planning is now offering pro bono planning. So if you really can't afford to pay a financial planner, contact the Foundation for Financial Planning, and they have now a list of certified financial planners who are volunteering to do some pro bono work to get you out of a guessing game. So with that, Kathy.
Yeah, so that last suggestion is really key, because an awful lot of the questions that came in are the kinds of things that an individual would want to talk over with a financial planner. And so the fact that they're providing it pro bono, if you haven't had a conversation with a financial planner, you may want to really take advantage of this at this time. But also, I'd like to mention that a lot of the questions are very specific about retirement plans, CSRS, FERS, FSPS, and FSRDS. So I've answered a couple where the AFSA website has the FSPS and FSRDS information on it, and so does the OPM site have the civil service actual retirement plan details. And so if you haven't taken a retirement seminar somewhere in your employer's benefits, or you really study whichever you are, foreign service or civil service, those two resources that you have that will give you a lot of those details. And Karen, there's also lots of questions about what will happen if I'm RIF'd, but I'm not eligible to retire. We don't have that clarity either in terms of the specifics that might affect you. I have to keep in touch with your HR office, if there is one, and your retirement counselors, and all these other resources like Social Security and TSP have extensively added to their materials and their webinars for you to give you information. Take a chance on that. And my former colleague, Alicia Dinnerstein, is putting together another website that will be really useful. You'll hear about that, and it will include a lot of these things. There was at the beginning, Karen, a few questions about what does it mean to give back to Social Security? I wonder if you might just take a
Okay.
on that.
Yeah. So that's not new. This is the way Social Security has always been. If you take a Social Security check at the age of 62 and your full retirement age for Social Security is 67, right? That's fine. You can take it. It'll be a much smaller check. But if you now go into the workforce and earn a very modest amount of money, for every $2 over this modest amount, and they can adjust it, and they do every year, but right now it's right around $20,000. If you earn more than $20,000, you will give back one Social Security dollar for every two over this amount, and you'll completely zero out your Social Security check if you're earning more than $43,000. So you don't get a choice about giving it back. They take it back. You don't get the next year's Social Security check, and they test it every year until your full retirement age under Social Security. So you already should have an account set up with Social Security, SSA.gov, set up your account. And the minute you look at your Social Security statement, what do you see? This is my benefit at 62. This is my benefit at full retirement age, which is what, based on the year you were born. And then this is my benefit if I wait to age 70. The penalty for working goes away when you get to full retirement age under Social Security. So you won't have to give anything back. Even though I'm working full time, I got my Social Security check, I don't give anything back. But if I would have taken it at 63, it would have been a waste of money because I'm still working, and they would have taken it back. All right.
Okay, so stepping back for just a minute, on slide 12, there was a reference to FEHB regarding delaying the pension or deferring it, deferring retirement. I think there's a little confusion. Maybe we could speak to that briefly.
Well, if I'm eligible for a deferred retirement, I retire and don't take my pension, and then I get my pension and my health insurance reinstated. So at the later date. So I'm thinking of a real person who retired from a Department of State career and had lots of and he had just he was in his late 50s. He wasn't eligible for an immediate retirement, but if he deferred it, he'd have enough years of service to his age, pretty sure it was age 60 or 61, something like that. And the big caution flag is, well, wait a minute, if you don't take a pension, if you don't take your reduced pension because you don't have your 20 years, whatever his formula was, you're not going to get any health insurance. He said, yeah, I think I'm going to be fine. You know, what he was able to do was find another job. And he was covered under his partner's health insurance in the job search. And then he found another job. And then when he was eligible for a pension that wasn't going to be reduced because he was underage, didn't have the years of service, that's when he got his health insurance. So it worked out, you know, it can work out absolutely great. But that's where to figure out what your best option is, you probably need a financial planner or one of these benefit specialists that Tammy Flanagan has in her company to really, if you go to OPM or you go to all of the resources that we've been giving you, and now you realize I have choices, which one's best for me? If the choices are accurate, any financial planner can help you with that. But if you can't lay it out, you don't know which ones you're eligible for, that's when you really need the benefit expert or the tools that AFSA's offering you.
Okay. We're not able to indicate the political impact on TSP or Social Security or the future of Social Security either. If we had a crystal ball, we could.
But I will tell you, Kathy, I'm hearing from a lot of people who are really worried that the government's going to use their thrift savings plan, and I'm very concerned they're going to make a knee-jerk reaction. As much as I love IRAs compared to any employer benefit plan. They're not for everybody. And somebody who's getting scared that the government's using their money is going to get talked into somebody's plan for them. So let's not overreact here. It's 401k money. You're totally vested in it. And the only way the government's using your money is if you got money in the G fund, because that's like a government bond, right? Where you've lent your money to the federal government. But it's the same with my whole career. We've heard all of the warnings about Social Security, and it's never gotten worse, right? It maybe stopped being enhanced as much, but this is not where our energy should be right now. We got lots of other decisions to make.
Okay, Karen, I wonder if you might expand just a little bit on the idea of techniques for surviving without a paycheck.
Okay.
Any
Yeah.
thoughts on that?
Yeah. So the very first thing that anybody who thinks they might be losing their paycheck sooner rather than later has to do, and I didn't have a slide on this, is look at their expenses in a lot of detail. So this is kind of a nice time of year to do it. Just use find your tax file or pile. It's around here someplace, right? And almost everything you need to do this cash flow analysis is going to be in there, maybe credit card statement, bank statement, login information, and really see in an average month last year where your money came from, short part of the exercise, and what you did with it. So that we know, well, if I lose my job, I'm not putting any money in thrift. That'll help. But I still have to have a certain amount of food, clothing, shelter kinds of expenses and come up with that number, right? What are your fixed overhead expenses? And then put everything in play on how we can just essential. We're just going to do essential spending, and we're going to look just as hard at other income. So I've got people having those conversations with their pseudo-adult children that they didn't want to have, like, you're going to have to pay rent now. Or we've had people just realize it's just habit. But, I had a young woman who was getting her hair and nails done all the time. And she never really looked at what the cost was because it was just her, right? She was paying it to different ways to be thrifty. And then when I said, what I did say was there are some great online sources for, I want to squeeze $1. And during these times, that's what we're going to do. We're going to look at just ways to be thrifty temporarily. I've had people rent out their apartments and go live with mom and dad. I've had people rent out extra bedrooms to get that extra income. I've had people put their car in a car share program just to get the extra income. All right. So it's not fun to think about, but if we didn't have a choice, we can do those things, and you might not have a choice for a while.
Many foreign service officers have not lived in the U.S. for many years, and it's difficult to project what financial needs are when they move back. How are there good resources for information on what an average grocery bill looks like by state, what utility bills look like? How would someone research those things?
There are, and I've seen different consumer reports every once in a while will go through a pretty accurate, this is what it costs to live in different areas. I have found that your network is amazing, because I would have the opposite problem. I've got a client who's getting posted in Madrid and has never lived in Madrid, and there would be all kinds of resources to see what you really have to take care of when you're in Madrid, and vice versa. You can come back. Your network will be able to help you. But the answer to staying out of debt is not going to be the grocery bill. it's going to be the property taxes, the housing costs, and transportation, utilities. Those are the things that are going to have more of a play than what it costs at the grocery store.
All right, I think it's time for us to say goodbye. I want to thank Karen Schaeffer so very much, and Caitlin Yardley for sharing their expertise with us. It was really wonderful. Thank you, Cathy McCormick, for helping us put this together, and Hannah Chapman, who's been working behind the scenes to support this Zoom. Please stay tuned and take our survey if you have a moment, and I wish you a good day. Thank you so much. Take care, everyone.